Hey Mom and Dad, I just wanted to do another video on the Vanguard New York long-term tax-exempt fund that you currently own. I thought that a big part of your financial decisions will be what to do with this fund, whether you should sell it, keep it, sell some of it. And so I did want to do a little digging into it. And basically this is a description of the fund. It invests in high-quality municipal bonds issued by New York State and local governments, and that is what a municipal bond is, and specifically, as it says in the title, it's New York, and the holdings, if you're interested, these are the top 10 holdings. They're all just a small percentage of the total. And, you know, Liberty New York Development Corporation, they issued a bond, and it's you're going to get the coupon payment on that bond. Here's the Brooklyn Arena, where the Brooklyn Nets basketball team plays. You have a total of 1,037 of these individual bonds. So it's very well diversified across different companies or corporation or projects. These are actually municipal projects, but it's all New York, so it's not diversified geographically. But I just wanted to show that, and this is a chart, same chart that I showed for those other funds of its performance, and you can see it's actually been on an uptrend. It has its when we had the global financial crisis, it pulled back some, but everything pulled back at that time, and you know, that's a nice chart overall. And I wanted to do a even longer term chart, which I got on Yahoo Finance, but this fund started in 1986, and this chart is basically over the years. I don't know when you bought it, but it really had a strong run, in part due to from 1980s, interest rates were very high, and as they came down over the years, bonds did very well in general, including municipal bonds, because the price of the municipal bond or any bond is inversely related to the interest rate. So I just wanted to show you the longer term chart. You can see that it's really done well, and I guess around June of 2016 it peaked at $12.31. It's come down to about $11.43 since then. So it's come under a little pressure, but it has had these pullbacks from time to time throughout its history. But when this is the Vanguard website, and they have, this is the New York long-term the tax-exempt fund, and you can see over the last 10 years its average return is 4.87%, which is actually really good, and it was 5.56% since its inception. This is each year it returns that much, so that includes a dividend as well as the price per share of the of this ticker. And so what I wanted to say is I didn't realize it was that good. That's better than I thought it would be, and I actually believe it's better than you know, you'd normally expect a municipal bond to perform, because municipal bonds are often you know, they might not perform quite so well normally, due to the fact that they are tax exempt, and because of that, people will invest in something that's tax exempt at a lower yield than they would invest in something that's fully taxable. But the fact that this still was able to deliver these kinds of gains is really good. I think you guys made a good choice. So I wanted to dig into it a little bit more. This is the credit breakdown. It's very good credit. This is all investment grade, so they don't have junk bonds in this, except for just a few, which will probably fall on angels. They're probably originally investment grade, but that is a fairly long duration, 6.8 years, which is and average maturity is 17.1 years. So, like with that long-term Treasury fund I was talking about, that's also very long-term. But with the longer duration, the longer maturities, you have interest rate risk. So that means that every time interest rates increase, the bond price will go down by it's more sensitive, and it'll go down by more. So that's actually a risk. Fortunately for you, during this time since 1986, interest rates have been going down, not up. So that this long duration has been a good thing for you. The bonds delivered more returns than it would have if it was a short duration. So, but that can reverse if interest rates go up in the future. And I just wanted to show you, here's a somewhat similar credit quality, pretty close actually, but this is Vanguard's diversified investment grade bond fund, and it has very long maturities, a little bit higher yield, 4.4% compared to 3.1%, and I think a lot of that is due to the tax advantage. You're talking about 3.1%, but it's after tax, it's tax exempt, and this is 4.4%, but that's fully taxed. So after tax, that's going to be a little bit lower. And this is an important point. If you pay a high tax rate, like 50% tax rate, and you had to choose between these two bonds, you'll go with a municipal bond at 3.1 because you're not really getting 4.4%. You're getting half of that after tax. You're getting 2.2%. However, for someone who is only getting maybe a 10% tax rate, I'm just throwing that up there hypothetically, you'd rather go with this one because even after tax, it's still going to be about 4.0%, much higher than 3.1%. That's just conceptual, but just keep that in mind when it comes to your own situation with regard to how much your tax rate is. But I wanted to show you and this is the point I was going to make here. This is an article from bankrate.com. This is from 2014. It's an older article, but they make the point, for clients in high tax brackets, munis can be superior to other fixed income options. And that's really why people like to invest in munis, because if you pay a high tax rate, munis avoid that tax. But people who pay a low tax rate probably are better off not investing in munis. So what is your tax rate? I don't even know what your pension income is and everything, but this is the 2019 long-term tax brackets, and you're probably 0%. Now long-term capital gains tax rate means if you sell this fund, if you sell the municipal bond fund. Now the dividend is a different tax. It's not a capital gains tax. It's the income tax. So this is a little bit confusing, but you're probably more concerned about the income tax on the dividend, that you get the 3-4% dividend on this fund. And you're married. I don't know what your income is, but assuming it's somewhere in there, 10 to 12%, it's very low. So to me, you wouldn't be a good person to be investing in a municipal bond generally. If you had a higher tax rate, you would be. So this is federal. There's also state tax in New York that can be pretty high too. But I'm just trying to give you conceptually how to think about this. I looked at this is just an interesting Boggleheads, and that John Bogle is the founder of Vanguard. So that's why they call them Boggleheads, people that like indexing like Vanguard. But they talk about they make some interesting chat room conversations, and made some points here, like municipal bonds are callable. I didn't realize that. And basically, when rates rise, bonds are less likely to be called unless their duration increases. This gives long-term munis more interest rate risk than indicated by the duration. So there is risk here with munis due to that callable feature. And there's some other. This was just interesting to read, but I think the one of the points that was made, if I can find it, was that you know, I thought there was a point about New York. If New York got into trouble, yeah, here it is. So higher yield comes with higher risk. You know, they point out if it will lose more if New York and cities have financial difficulties. So that's just, you know, something that everybody knows, but keep that in mind. It's not all that diversified. Now here is a municipalbonds.com, a nice article that goes into, you know, the risks, and they make this point at the end. The bottom line is, in approximately 20% of cases, municipalities are facing dangerous budget shortfalls, and the rising threat of higher interest rates could translate to lower bond prices across the board. So they talk about that in the article too. They talk about this report that said approximately 20% of the muni market has a deteriorating or structurally imbalanced credit profile. These municipalities are experiencing slow growth revenues and rising expenditures that put them on unstable ground. Another recession could put these issuers under pressure and spark another wave of defaults. Now they're saying another wave compared to the mid-2009 wave of defaults during the Great Recession. And they link to this report by PNC, just a brokerage firm. This was from 2016, so it's not new, but it's still important. Here's the report. It's a good report. I skimmed it, but they talk about this Meredith Whitney, who was a very, like, you know, famous research analyst, was on TV a lot, got a lot of media attention, but she actually predicted that there'd be a meltdown in many, you know, municipalities because of the problems financing their expenditures. So they had a interview that was all about 60 minutes, state bailouts, day of reckoning. She was asked, you know, she said, there's not a doubt in my mind that you will see a spate of municipal bonds default. How much is a spate? Said the interviewer. You could see 50 sizable defaults, 50 to 100 sizable defaults, more. This will amount to hundreds of billions of dollars worth of defaults. And when individual investors look to people that are supposed to know better, they're patted on the head and told it's not something you need to worry about. It's something to worry about within the next 12 months. Now, this call that she made that there'd be all these defaults turned out to be false alarm. There weren't this big wave of defaults, because this was, I guess, 2011, 2010. So this was after the financial crisis. So you had that set of defaults, but then they never had this meltdown that she predicted. So she was wrong, but still, she did a lot of analysis. Here are some examples of some the municipalities that did default. Detroit filed for bankruptcy. So it's not, you shouldn't assume there's no risk. And here's municipal credit spreads. Basically, if it's high, it means there's a lot of risk. If it's increasing, the municipal bond value is decreasing. And you can see that part of the reason you've done very well in your investment is it's been going down. And probably the more relevant spread to you is the AA spread and A spread. Those are higher quality. So it's been going down. It's been kind of flat. But if those start going back up, if these graphs start going back up, your municipal bond value will go down. So it's an interesting, thought I heard someone, it's interesting, and you know, they they basically, this PNC Bank is basically saying, you know, there's a lot of uncertainty here, and I just wanted to make sure you understood what you're getting into. So the bottom line is that I think that municipal bonds are not necessarily a buy and hold investment. If you just buy and forget about it, you could see that they are facing a lot of risk. It's been a great investment for you guys, and you should be applauded for making that investment back, you know, 10, 20 years ago, whenever you made it. I don't even know, because it's done very well. You know, that return, that first graph, the first table we looked at had, you know, almost 5% a year return. That's a very good return for a bond, and especially a tax-exempt bond. The question is, will that continue? You know, past performance does not predict future returns. That's something we're told over and over again, and it might be the case here, because you have a risk of a bond bubble. Just overall, bonds have been in a bubble, just like the stock market. And with the Fed hiking interest rates, all bonds, municipal bonds included, would get hit pretty hard by that. Now, we don't know that'll happen. The Fed could stop interest rate hikes and even cut interest rates in the future. That's a big question, but there's a risk. There's also a risk of the New York State defaulting. You know, maybe municipalities that have some of these projects default, and you won't get paid. You won't get paid for the bonds that are impacted by that default. And not necessarily. It's you have 1,000 bonds, so I'm not saying every single bond, but some of the bonds could default. And especially with the state of New York State finances and budgets and overspending, you could see that risk increase in the future, especially if we have a recession. So, and I think it's important to point out that since you are receiving a pension from New York State, it's not good diversification to also put all your investments in New York State bonds. That would, both your pension and the bonds have some risk associated with New York State's fiscal stability. I don't think your pension is really under risk, but you know, this is if there was ever anything that happened that would impact your pension, maybe they cut your pension by 10% or something in the future. I think you not want to also have your municipal bond value reduced significantly. You'd rather be invested somewhere else that wouldn't be impacted by that. Anyhow, so just my thoughts, and hope you I'm not saying I don't want to tell you what to do, but I'm just giving you some information that you might not have. All right, I will sign off. Bye.